All right, Steve, you ready to get started?
Yes, I am.
Excellent. All right, good morning, everyone. Thank you for getting on this morning. My name is Ted Harris, and I'm with the Pennsylvania Petroleum Association. This is a part of our monthly webinar series, which happens the first Tuesday at 9 a.m. every month. For those of you who have participated in this before, thank you for getting on again. And for those that are new to this, we appreciate you giving it a shot and trying it out this morning. I hope, I'm sure today, as well as our other webinars moving forward, are certainly worth, the 30 to 45 minutes time spent watching it and learning from it. At this time, I am gonna introduce our presenter, who is Steve Abadi. Steve is the managing director of C-Corp Associates. I will let Steve talk a little bit more about his background and his experience in a moment. But before I do pass it off to Steve, I would like to encourage or just outline that every attendee on this webinar is going to be muted. But we certainly encourage questions throughout the presentation. And what we're going to do is essentially, once Steve is done with his plan presentation, we will address any questions at the end, which normally could be a few minutes or up to 15 minutes, depending upon how many questions we get. So there is a chat or a question feature on the GoToWebinar platform, and essentially, please ask any question that way. And if for some reason Steve cannot answer it, or if we don't get to it today, we will make sure that you do get an answer after the webinar is over. So with that being said, I will pass it off to Steve. Steve, thank you very much.
Sure. Thanks, Ted, and thanks everyone for attending this morning. I really appreciate it. I am the owner of C-Corp Associates. You may also know Doug Woosnam, who's my partner in the business, who's very involved with the Pennsylvania group. So my background and what makes me qualified to give this presentation, I've been in the industry for 30 years. I've worked my way up from selling heating oil to equipment to running a 60-person branch. And I got involved in business development, mergers and acquisitions, probably about 25 years ago. I've been involved in somewhere between 160 and 180 transactions over that period of time. Mostly heating oil, propane, some gas station work, but all in that side of the energy industry. So how do I know how much business is worth? Well, I make a study of it. That's what I do. And we've also, in the last 2 years, we've represented around a dozen companies for sale, and we've taken over 100 offers on those companies from about 95 different buyers or prospective buyers. So we get a pretty good flavor of what people are willing to pay. And there's an old adage, how much is your business worth? It's worth what someone's willing to pay, which is pretty much true in a sale transaction. But there's some other parts of business valuations we're going to talk about where that might not be as true. And I will review that with you. Okay, just a quick outline. We're going to go through some general definitions, some basics, talk about EBITDA, earnings before interest, taxes, depreciation, amortization, also known as cash flow or operating income. We're going to actually walk through an example of a financial model to do a valuation. We're going to talk about adjustments to financial statements. What are the real value drivers that make a business worth more or less? We'll also talk about return on investment and return on equity, which is a term that people might not be as familiar as return on investment. Okay, so a business valuation is it's a process, a set of procedures to estimate a value of a business or a specific owner's value in the business. This is used, we use it primarily for purchase or sale of businesses. But we also do valuations to resolve issues with estates and estate planning. Um, for probate, we've done them before. Gifting is a great way if you have family in the business. It's a great way to save on some taxes. So we do valuations for that. Divorce litigation, owner interest buy sell agreements, and those tend to get updated pretty regularly, or they should be. They can also be used for budgeting and planning. What we do is we actually do a financial projection. And a lot of people use that for budgeting. And then the one we get most often is I just want to know what my business is really worth. You can you can look up your bank account, see how much money is there. You know about what your house is worth, but your business could be one of your largest assets, and what is it really worth? And until you go through a full process like this, you just don't know. Okay, so there's two general categories of valuations. There's valuing a business as a going concern, which would not be for the sale of a business. It would be more for stock gifting or buy-sell agreements. Sometimes it's used for probate if it's passed down to a relative. It's good for planning, budgeting, benchmarking, and just to understand company value. And then there's the second category of valuations is the value in a sale transaction. And in a sale transaction, it's actually three categories. Fair market value, as you can see, is highlighted because that's the most common. Fair market value is the value between a willing buyer and a willing seller based on a cash transaction using industry accepted standards. And both parties would not be under any compulsion or duress to buy or sell. And both parties are aware of all the relevant facts associated, full disclosure, fair market value. Orderly liquidation is also between a willing buyer and a willing seller, but there's a time frame on it, typically 120 days or less, meaning these assets need to be sold. It's a little bit of a fire sale. It has to be sold, and that's a lower value typically. And then you have your liquidation or your auction value. Here it's mostly related to hard assets. The customer list in our industry at this point, depending on the time of the year, may have no value because if it's the middle of the winter, those customers are gone. So those are the three basic type of valuations. So in the valuation itself, the pieces of it are, an overview of the company. What is the purpose of the valuation? Those items that I mentioned earlier, it's important to state what the purpose is, whether this is stock gifting where you might have discounts, which we'll talk about, or is this for a sale, or is it for I just want to know? What is the industry overview and what trends are happening in the industry? In our industry, we have some attrition going on. We have natural gas conversions. So, we look at those trends and what's happening. What's the overall economic overview of the industry and of the country? The biggest piece that we focus on is the financial analysis because that really gets you what the value of the business is. Then we talk about different valuation methodologies. There's those valuation discounts. Usually they're for minority non-controlling interest. That's typically done on a stock value. I should mention that in a sale transaction, businesses typically sell their assets, customer list and intangibles, vehicles, propane tanks, real estate. That's what buyers buy. They usually don't buy the stock. It's very, very rare to have a stock purchase. The value of a stock of a company is typically worth less than the value of the assets because of the liabilities associated with it. So then we also the equity value of the value itself. Where does that come from? Is the last part, and then the credentials of the person doing the valuation. There's three approaches to valuations. We use a combination of all three approaches. The first one is called the asset approach, and it deals with substitution. Your 2010 International 2,800 gallon tank wagon or your bobtail, it's got a specific value, so that's fairly easy to do. Same with propane tanks, property, plant, and equipment. Usually, you can get a pretty accurate appraised value because you could always move somewhere else. Maybe not that easy, but it has a value to it. The market approach has to do with supply and demand. And it looks at comparative sales data, although there's not a lot of public information available about, retail fuel businesses because they're privately held. But as an example, propane companies right now, there's a big demand for propane companies. And so because the supply is not there, it tends to drive the market up. So the valuations on propane, even if it's combined with oil, it helps drive up the oil value as well for the total company value. The area that we really focus on the most is the income approach. This is related to the future benefits, return on investment, and we use a multiple of EBITDA, a multiple of cash flow, operating income, to come up with that value. And it's a return on investment. It's not a cents per gallon business. It's not a multiple of margin. I get that a lot. People say, how much times margin are companies selling for? Well, if someone's got a 70-cent margin, they're dropping 10 cents to the bottom line, and someone else has an 80-cent margin, they're dropping 20 cents to the bottom line. The investment in that company dropping 20 cents to the bottom line would be higher. Maybe it's not twice, but it's definitely higher than if you just did a multiple of gross profit or of margin. Okay, we talked about these are common return on investment methods. EBITDA multiple is the most common one used in all industries. Distributable cash flow, this is used a lot by master limited partnerships, a lot of the larger propane companies. And basically, it's your cash flow, your EBITDA, minus your capital expenditures. So what can be distributed to the owners of the business, or to the stockholders in many cases. Then return on equity is a formula which I like. It has to do with leverage. So if an owner borrows, we're going to get into this a little later. If an owner borrows 50% of the money to do an acquisition, then his equity piece is 50%. And what's the return on his equity after he pays, the loan rate? 5-6%, whatever the loan rate is. So return on equity can be a very, very high number, higher than most people think, and we'll go through some examples in a little bit. Okay, so the three EBITDAs. When we look at a financial statement, we usually see that the company didn't make any money or very little money because the owner was paid out. Out of the business, so the business doesn't pay a lot of taxes. So we have to adjust that, and the way we do that is we go through and look at non-recurring revenues and expenses. We adjust owners' pay. We're going to again go through an example of this, and that adjusted EBITDA number is the number that we use to do a valuation. The third EBITDA is a buyer's EBITDA. And this uses the adjusted EBITDA and then any kind of synergies and adjusted expenses. So if insurance costs are lower or higher for the buyer, then they would adjust that. They might have a different benefit plan. They might, I still saw for the first time in about 7 years a company that paid 100% of their employee health benefits. So a buyer coming in is going to have some additional expense there, or they'll have to make some kind of adjustment for that if they're not going to continue with that. So, you need to do your homework if you're looking to buy a company to see what your return on investment is, what your EBITDA will be. Okay, so how do you get to this number for the valuation? Well, we like to follow the income statement. We look at the financials and we look at the balance sheet. It gives us a picture of the health of the company and various things that may have happened throughout the year. But the income statement is really what we follow the most. We want to see where the revenues came from. They come from the fuel, from the service. Do they have other revenues from other sources? So we want to really look at that. Sometimes we get like hedging revenue, cap price programs in there. We have some companies that actually have delivery fees or tank rental fees. So we want to capture all of that under revenues, and it should be on the income statement. Then we want to get the cost of goods sold. Now, when we do our valuations, a lot of accountants like to put direct operating expenses in cost of goods sold, driver wages, truck fuel, service wages. We back that all out. We like a pure, what are the fuel costs? What are the service parts cost? So we back that out to get a real gross profit, because revenues minus cost of goods sold is your gross profit. It also helps you analyze your margin better that way. And then your operating expenses, and those you really got to go through pretty carefully, and we're going to go through an example of that to see what's a real operating expense and what would maybe not continue or wouldn't be there if the business wasn't privately owned. There's some owner expenses we see in this quite a bit. Okay, so I'm going to get into an actual financial model that we did. This happens to be a heating oil company, and with a good HVAC service. They did not have propane, although we do see a lot of propane companies, combo companies, more and more as people have diversified into propane. So we always like to track gallons to see if there's a trend, and we like to weather normalize those gallons. And we do that by we use Weather Underground. We use a 10-year average for the nearest airport or location, and then we'll adjust gallons accordingly to see what kind of attrition really is there, is there growth. We're dealing with a company right now that has 4 years of average growth of 4% in heating oil, which is very unusual, but they have a very good business model. So we take a look at those things. And then what are the revenues? Revenues aren't, many businesses would look at this. Let me get a little drawing tool here. And they would say, okay, you were at 8.4 million on your heating oil. Let's go to the total. You were at 10.8 million in revenue, and you dropped to 7.1 and you're projecting 5.6, this business is in trouble. But as probably all of you on the phone realize, we're a commodity-based business, so revenue is not really the key to what we're looking at. The key to what we're looking at is gross profit. Okay, so again, we add up all the revenue. I like to break out service contract, non-contract, and installation if I can get it, because usually there's, again, it shows you trends in the industry, what's happening with the business. And other revenues. This one has customer finance charges, and actually there were cap fees under the other section to get your total revenue number. From there, you back out your cost of goods sold, by product. We had a hedging reconciliation here. The owner did not cover correctly, so we actually did an adjustment on hedging because we're trying to normalize the earnings here. Okay, so this is the money slide. So we get our gross profit and we see where the gross profit has been. You can see this one in 2015, it jumped up pretty good. When you see P, it's projected. That's weather normalized. We use the actual numbers for the company. So 15 was a great year for most people. The market went down, margins stayed up. So you can see this business did very well. But when we project it out, we're projecting it to go down. And then it goes up slightly again. And Gregory and Gray does their oil heat survey, and we've tracked it the last 15 years. And the average increase, it's a targeted number, but it's fairly accurate, is 2 cents a gallon on heating oil. We use 3 cents on propane. That's approximately how much every year the margin goes up or should go up to offset your increased operating expenses. If there's high inflation, the number will be higher. If there's low inflation, the number will be a little bit lower. But you do need to increase your gross profit because your operating expenses likely will increase as well. What you can see in the bottom here, the operating expenses go from 1,581,000 all the way up to 1,628,000, mostly due to inflationary pressures. So then you take your gross profit, fairly easy. You add it all up, minus your operating expenses, and it gives you your EBITDA, your earnings before interest, taxes, depreciation, amortization. We just pull those items off the income statement that we get typically from the accountant. We just back out the depreciation, especially now that they have the accelerated depreciation. That doesn't really give you a realistic expectation of how much money you're going to make with this business. Okay. Now we get into operating expenses, and there's a couple of interesting ones here. Bad debt. This is an item that people will bank, so to speak. They accrue bad debt and they use it when they need it. Some companies are pretty good at keeping up with it regularly, but we, when we see this, we usually analyze it, and we use an industry standard, which is between 1/4% and 0.25% and 0.5% of revenue. So this being, higher in 2013 when the revenue was $10 million versus our projection of 24,000 when the revenue has gone down to 5,000-6,000. That's all relative. It doesn't mean there's less bad debt. It's fairly consistent. We usually this was in a sale transaction, so we usually take things like advertising, and this was inconsistent, so we did a 3-year average, I think, on this one. Let me see what else. And we'll see a lot of times there's certain items like that'll just pop out where they have it in 1 year and they don't have it in other years. We try to figure out why that is, but we just left that blank because we figured it was captured somewhere else, wherever that benefit was. Now you notice health insurance dropped. That's because the owner was leaving the business, so we projected it based on who was going to be left. Insurances pop all over the place, depending on your loss run rates, things like that. Oh, let's see. Jump down to owner salary, officer salary, which was the owner in this case. So this particular owner, was making around $500,000. He had a good year in 2014. That's what he was physically taking out of the business. And you notice moving forward, we took that out of there because the owner was no longer going to be working in the business. Then we figured out payroll taxes. These benefit items are related to the total payroll. That's why you have this bump down here. So we do it as a percentage of wages to do our projections. Same with pension expense. That was a lot of the owner's expense in there. On the next page, the one that pops off, professional fees. This had some consulting fees in it that wasn't going to stay. Plus, a buyer is going to have less accounting fees and things like that. So we project less there, and we encourage buyers to do that as well. The rent. Many owners hold the property in a related company. This owner held it with his brother in an LLC, and they paid $1,000 a month. But they wanted to keep the property, and they wanted to lease it, and so the lease amount ended up being $60,000. So we wanted to capture that in our projections. The salaries and wages. This week we typically increase it. We adjust the driver wages. We do it on a per gallon basis because it's all over the map, and then we put inflation into the per gallon amount, and then we just do a 1.5 or 2% increase annually to account for inflation. Travel and entertainment was all owners' expense, so that wasn't going to continue. Vehicle repair had owners' stuff in there, so that was going to be less. And then you'll see this big adjustment number, which we're going to get into a little bit, in order to come up with a normalized operating expenses. This is adjusted. Now, a buyer may eliminate an accounting person, or they may have cheaper insurance, or they may have other benefits that they have to add to it. But this is the number we use for that. This is just a sample. This isn't, some of this is the same company, but I added some other items in here also. Just to kind of go through it, personal gasoline. Now, when you're paying, when an owner is being paid, and what we try to do when we represent an owner is we try to get every single expense that would not occur after the sale of the business, so we can show the buyer, hey, this is really what your earnings are going to be. The owner and his wife take gasoline out of here. His mother gets free heating oil. He gets free heating oil at his house. He gets full health coverage that's paid out of the business. His two kids kind of work in the business. It's really a way for him just to pay them something. They're not going to continue there. So you add the wages, and then you figure out what the Social Security and the federal and state unemployment taxes, all the other items. Let's see. There's a couple in here. Parking lot paving. We see this type of item occasionally. This should have been capitalized and depreciated over the life of that repair. But we see it also in auto repairs. Someone rebuilds a transmission or an engine, and it extends the life of the vehicle. But they tend to expense those items when really proper accounting would have them depreciate those items. So we add that back and say, no, that's really that's got to be taken out of the EBITDA. And there was some trading of boat storage for fuel, and a couple of other things like that we occasionally see from owners. I lost my cursor. There it is. Okay. And then there's that hedging adjustment we talked about. And there was some work done to his house and things like that. New central air conditioning system. Probably shouldn't have gone through the business, but these things happen, and so we just adjust for them. Okay, so you've now gone through your analysis of an income statement. You've figured out what the revenues are, and you have to do your own projections of where you think margins are going to be, on where you think attrition might be, to project out your revenues. You've gone through the expenses and you've figured out, okay, this is probably where we're going to be on operating expense. So now you have your operating income, your EBITDA. But the big question is, okay, companies trade at a multiple of EBITDA. You might have heard that. What makes the multiple? What makes it a 2, a 3, or an 8? And so that's where you get into value drivers. And the most common ones are, automatic delivery. I'm going to put the other ones up here. Automatic delivery percentages. The diversification, I mentioned propane. Some companies diversify into other items like pest control. Is that a positive or a negative? Well, it may be very good for that owner and could be doing very good with that business, but and And in a going concern transaction, we would take that into full account, but it's probably not a desirable line of business for most purchasers. So they might discount that a little bit, as opposed to propane, which everyone's looking to buy. So that would be higher. That would drive that value driver up. Vehicle and equipment age. Just did a valuation last night for someone. Their average age of their trucks was 17 years. And the typical that we see is somewhere between 10 and 12. So a buyer coming in is going to need to make another investment into vehicles. So that would drive that's where it drives that multiple down a little bit, because, on their return on investment, they got to make additional investment. And the opposite too. We've seen, 3-year-old fleets, and in that case, the buyer does not need to make an investment for several years, and we try to point that out to them, and that usually means a higher multiple. Fuel storage, propane storage is hot right now. If people have 30,000 gallon propane storage tanks, loading racks, that will help drive the multiple up. Just because that secure supply makes this a more secure business. Concentration risk analysis. That's something that we do in all valuations to see if there's very few customers that have a large percentage of the volume or of the gross profit. We did one recently where their top 2 customers accounted for 15% of the gallons and about 11% of gross profit. So that makes it a little riskier. So while I have it here on the value drivers for multiples of EBITDA, it actually usually will result in an earnout. And we haven't really talked about earnouts, retained gallons, retained gross profit, those type of things. When there's a risk that if a couple of customers leave you, it could really hurt the business, usually you have to have some kind of earnout attached to that to say, well, if you keep them for a period of time, we'll pay you, but we really don't want to pay for that up front. Bids and co-ops, very similar. Would you really pay for a bid business when next year it's up for bid again? So you have to kind of look at what's the history of that bid business. Have they had bid business for the last 5-10 years? It might switch around, but you kind of have to give them some value for that. Co-ops is another great one, because who owns that customer? If the co-op owns the customer, what's really the value? There's some money generated there. That again usually feeds into more of an earnout situation. If they continue to make money from that co-op, then usually buyers will give them a piece of that. We talk about percentage of company-owned propane tanks. That locks in a customer. That's a big item, plus the value of the tanks. Exposure to natural gas in your market and conversions to natural gas, that could lower the EBITDA multiple. What's the competition for those assets? There's certain markets where companies are very spread out. There's not a lot of buyers in that geography. So the value is less for the same EBITDA company, the same product mix, the same percentage of automatic delivery, but there's just not a lot of buyers in a market. As opposed to other markets, we just fielded 13 offers on one company up in New England. So there's big competition for assets. That drives up that multiple. Are there any non-competition concerns? Did a family member leave the business and open up a competing business, 5 miles away recently? That we've seen that too. Growth and attrition trends. What's going on in the business? That could drive that. And the size of the business is one that really needs to be understood. You look at a small company, 300,000-400,000 gallons, and the husband's out on the truck and the wife's in the office answering the phones, and they have one other person working. they now go to sell that business. There's such a tight relationship between that owner and that customer that it's a riskier purchase. And for that reason, the multiple tends to be lower, and larger businesses sell at a higher multiple of earnings. And we're going to see that in, I think it's the next slide that we get into. Next slide and the last slide. This is just an example, and I did this basically on heating oil. You'd be higher for propane. These multiples would be at least 1x higher, maybe 2x higher, depending. But you can see a company that has a $75,000 EBITDA that may only trade at 2 times earnings, and that would trade for about $150,000. Now you got to, when you get small companies, you got to look at the vehicles. Normally, what's included in that multiple is vehicles, furniture, fixtures, and equipment, propane tanks, and customer list and other intangibles. Those are the 4 main assets that are included in the purchase price. So if they have a new truck in this example, then you might separate the truck out and pay them for that separately. Now, if you look at return on investment and return on equity, if you paid $150,000 out of your pocket or out of your working capital line, or what I would say out of your pocket, out of an owner investment, then you're going to make around 50% return, because you're going to get $75,000 back every year, and you'll be paid off in 2 years. If you borrow half the money from a bank at 5% interest and pay off that loan, then you're only putting in $75,000 of the 150, and then your return on your equity investment is 95%, which is a big number. And you can see that throughout this. This is the power of leverage. If we move to the $1 million EBITDA business, if you pay $3.5 million, if you pick it up at 3.5 times, which would be a heating oil company primarily, a decent heating oil company will sell in that range. Your return on investment, if you use all your money, is 28.6, but your return on equity could be over 50%, because you're getting $1 million back a year, but you borrowed money from the bank. So that's very important to understand that. Now, the difference for an owner selling between $3.5 million and $6 million is a big difference. So this company at 5 times, almost all automatic delivery, has some maybe real estate in that purchase price number, maybe the one up top, it's a lease, so they're not getting the hard asset. Propane or other growth in the business, if they're showing growth, consistent growth in the business, you could see a multiple up as high as that, just for heating oil business, which is good stuff. And then you get into bigger, you get into these $5 million numbers. Now you're attracting, you would think you have less buyers, but actually you bring in a whole nother group of buyers. You bring in your private equity groups when you get that high. And so those multiples actually go up. They would even exceed this chart more than likely. So this is just to give you an idea of ranges that we see for your heating oil, maybe a little bit of propane. Propane numbers, again, at least 1 time more just for the tanks, if they have a lot of company-owned tanks, and then another 1 time just for competition for assets. And we've seen, propane companies go as high as 9 and 10 times multiples for these larger companies. So it's kind of what we're seeing in the market right now. That's my presentation. I hope you understood most of it, and if not, I'm open for questions.
Excellent. Thank you, Steve. I did type a question that came in, and I sent it to the entire audience. You should be able to see it in the chat feature. on your GoToWebinar pop-up.
Okay. How do you value the vehicles and equipment? Wholesale, retail, replacement, or some blended value? Is that the question you're referring to, Ted?
That is correct. Yep.
Okay. We do the vehicles on a fair market value. We find a lot of buyers, and the sellers usually don't disagree. A lot of buyers will say we'd like to bring in a company to do that vehicle valuation. It depends on the size of the fleet. It is a fair market value, so it's between a willing buyer and a willing seller. So what that vehicle would sell for on the open market is how we value them. Now, when we do our valuations, we look at that EBITDA multiple, and we see what's the total. So if the total for the business is $4 million, and that's got furniture, fixtures, and equipment, including computer systems, telephones, desks, chairs, file cabinets, and it also includes vehicles, then we will usually just do a vehicle valuation, estimate the furniture, fixtures, and equipment, and we back that out. Propane tanks is the other one. We take out the value of the propane tanks, and I can talk about that too. And then what's left is really the customer list and intangible assets. So we know what hard assets are. If you go back to the beginning of the presentation, it's replacement value, and whatever's left is your intangible or your customer list value.
Very good.
Okay.
Yeah, I added two more, and I just had another one come in that was essentially an extension of the customer list question. The third question that I typed, which I'll also add here.
Yeah, on occasion, on a small company, I think I mentioned this, you can use a smaller multiple because that tangible asset, typically heating oil companies, 85% of the value is intangible asset, customer list, somewhere between 80 and 90%. On a propane company, it tends to be in the 55 to 65% because you have a lot more hard assets in a propane company, and it's very leverageable. That's why you take that market value. The asset value approach. What a propane tank is worth. We usually take new value and we usually depreciate them 50% if people have been in the propane business for a while, and that's your propane tank value. And then you have your truck value, and then you have your equipment value, depending on we usually look at a depreciation schedule. And whatever's left after you take the hard assets, that ends up being the value of your customer list.
Very good.
Inventories, very good question. On day of sale, added to the purchase price or included in the multiple value. This is interesting because there's two methodologies on this, and people call it different things, but enterprise value typically includes inventory and receivables. We rarely do those. Even when we do them, we like to back out. Inventories are usually valued on the day of closing, and added as a separate asset number, as well as our receivables are usually collected by the purchaser and remitted to the seller. Although we have seen where they've just been purchased. Usually they're purchased at a discount. So that's another asset which I haven't talked about. Those would be in addition. Those are what we call working capital assets, and they're in addition to the other assets of vehicles, propane tanks, trucks, and customer list.
Very good. And there was another question that was in between the other two that you answered. How do you value the stock of a company?
Okay. Stock values are done differently, and I personally do not do stock valuations. We're an accredited valuation company, but you have to be a CPA with a certified valuation analyst's credential. And they're much more complicated. They're much more expensive to do. What I do though is I'll do a discount for purchase of stock. Like if it's I have one right now. It's three brothers and one wants to leave, and they all have stock. So we do the asset value, and if we come up with $3 million, and what's the stock value worth? It's something less than $3 million because that stock you can't sell it on the open market. It has liabilities that seller is now going to be out of those liabilities. And so, we have this with 50-50 owners. An owner that owns 50% that wants to get out of a business, the value of his business is less than 50%, just because he's the one that wants out, and the other owner who's going to remain with all the stock is going to assume all those liabilities. But you would get into, mostly when we do valuations, the reason people do these asset valuations is because if you look at your balance sheet, there's a couple of items that just are not valid. One is vehicles, because you've depreciated them, but if you went to sell all your vehicles, they'd be worth a hell of a lot more than what the depreciated value is. Same with propane tanks. Not as much, but they'd also be worth more. They're tougher because you got to disconnect them, and then there's a cost involved with that. So actually, they're closer to like an orderly liquidation value on propane tanks. I'm losing my track here. So in stock valuation, okay. So what you do is we restate the customer list value. If it's a company that doesn't do acquisitions, their customer list value is zero on the balance sheet, yet it could be a $2 million value. And then you're going to have, in a stock valuation, you're going to have your notes payable, your notes receivable. So you're going to have to take all of those. You're going to have to pay off all your debt. So the value of the stock is very different. It has a lot of moving pieces to it. You have to pick a point in time as well to see what your working capital was at that time. Hope that wasn't more than the question.
No, that was good. That is all the questions that I received at the moment. If there are any more questions, or if you do want to get in touch with Steve, I'm sure you can contact him through going to the website that's listed on the screen. If you want his contact information directly, feel free to reach out to me, and I can certainly pass that along. But at this time, I think we're going to wrap up. And Steve, thank you again. Very good presentation, and I hope everyone walked away with something valuable today.
Great. Thank you, everyone. Thank you for attending. Like I said earlier, I really appreciate it. It's nice to have this opportunity. So, Ted, thank you for inviting me as well.
You're very welcome. Thank you all.
Okay. Bye.
Have a good day.
You too. Bye.